Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Hey everyone, I'm Alix Steele.
And I'm Jen Ryan, filling in for Paul Sweeney.
On today's Bloomberg Intelligence show, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at how computer tech company Oracle is showing progress in its bid to capture more of the competitive market.
Plus, we'll discuss how a physics whiz made a fortune betting on nature's catastrophes.
But first, let's take a look at retail. You got department store Kohl's reported same-store sales that fell 4.3% in the fourth quarter. That represents a small improvement over the 5.5% decline during the prior quarter. It also shows, though, that Kohl's has struggled to attract shoppers during the holiday shopping season.
For more on this, we were joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail. And Mary told us she's still optimistic that Kohl's can boost growth.
They do have Sephora, and I'm sure that Sephora carries the brands that you care about. So Sephora has been a key driver for Kohl's, and that's the reason why their sales aren't that bad. You know, if you look at the comp sales, they fell 1% in the quarter at the stores. So total comp sales were down 4.3%, worse than consensus 3% estimate, but digital sales were down 10%. And now going forward, after we get beyond the first quarter in 2024, we should see the overall comp sales do better. One, with the Sephora initiative, because the comparable sales for Sephora was up 25% in the fourth quarter. So we've been seeing double-digit increases there. So that will help. But there's a number of other initiatives, including the news that they're going to be putting Babies R Us shops into about 200 stores by the fall. And that really fills a void in the market. I'm sure you're aware that, well, what happened with Bye Bye Baby? And what about, remember, Toys R Us? That used to be a go-to place when you were expecting or had a baby. You could go there, get your strollers, get all your products there.
We talk about what's good in their future. It sounds like it's a lot of stuff that is not Kohl's. It's Sephora, it's Babies R Us. What's the issue with the fundamental core Kohl's offering?
So they're revamping the merchandise because that was part of it, is just not having the right assortment. So they're redoing shoes, and they're going to be bringing in Skechers. They already have Nike, they have Adidas. And now you're also going to see them bring in some youth brands. So they're going to bring in Quicksilver, Aeropostale, Madden, Limited 2, and Roxy. So those are also going to be helping on the apparel side. So with the overall revamp that they're doing on apparel, and some of their private brands are actually, they resonate pretty well. Like in babies, they have Jumping Beans, that does really well. So it's really a host of a lot of things that they've done with the stores. If you go in them now, they're a lot brighter. The culture there has really been boosted. We've noticed a difference just from a year ago on how much the stores have been transformed. And so that's helping.
Yeah, that's so interesting. When I went and I was looking in, kids grow like weeds, right? My daughter's 9, so I was looking for pants. And I was like, oh my God, they have Nike? I was like genuinely like it. I had lots of those moments whilst walking around.
I'm going to have to check it out.
Okay, we're listing all the good stuff here. So why did Kohl's give weaker than expected guidance for the full year?
Part of that is because we had a new ruling that came out from the Consumer Financial Bureau saying, okay, we're going to cap late fees on credit cards to $8. So that's going to have a negative impact for department stores generally because they tend to have the biggest exposure. And so Kohl's is one of them. They generate a fair amount of income from their credit card portfolio. And so they guided that income will be down mid-teens. And that's about 135-ish million is what we're estimating the impact this year. And that's not the full year impact. But they introduced a co-branded card. And in 2025, they hope to be able to offset the loss of income that they'll experience, but we'll see. But that's one of the reasons why you're going to see some pressure on the margin side.
What's the consumer favorite these days? I mean, you've listed all these interesting brands turning up at Kohl's, but is that enough to get the consumers through the door? Or, can you tell us a little bit more broadly about the retail space? Are there other shops that consumers are preferring these days?
Yeah, well, clearly off price. And when you think about what's happening here with Kohl's, they're buying frequently, which is more of an off price strategy. There, all the buying occurs on a weekly basis. Tom Kingsbury, who's the CEO, he is the one who turned Burlington stores into the fast growing off price retailer that it is. He lends a lot of credibility. So yes, you're seeing the consumer that's attracted to Kohl's. They also shop at off price, and off price has been a big winner for that value consumer. And then other retailers that are doing well are those that are executing and really delivering on the merchandise. And so I'm speaking to apparel retailers like Abercrombie, Urban Outfitters with their Anthropologie and their Free People brands. So it's really, it's kind of a tale of two stories. Those that are executing are delivering on results. And here we're in a transition phase at Kohl's, and they're hoping to be able to turn the tide of declining sales for this department store operator. And they do have one benefit. They're off the mall, not in the mall. That makes them different. So it's easier, to get into the parking lot, get into the store and get out again. So it's easier access. And like you pointed out, they have Amazon returns. It's not additive to sales, but it does bring in traffic.
True.
And then more importantly, Sephora has been the biggest driver.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
We move now to the airline industry and Boeing. So Boeing has been dealing with the growing fallout from an early January accident that has since plunged the company into crisis, and it's also caused Boeing to reduce aircraft deliveries.
As a result, Southwest Airlines announced this week that it plans to cut capacity this year, halt most hiring, and review its spending plans. And separately, Boeing said that its aircraft deliveries trailed rival Airbus last month.
So let's get more on all of this. We were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, and we asked him how challenges at Boeing will impact the U.S. airline market going forward.
I think that the Boeing challenges will provide a little bit of firmness to the marketplace, but I still see I think a U.S. airline market that looks like it has plenty of capacity in it. And I still think fares are flattish to maybe going down for the year unless Boeing really curtails their deliveries for the year.
Yeah, it's interesting because if I read this issue about Boeing and I read this cut in capacity, but my first thought is going to be that means higher prices for consumers. So what accounts for the difference there?
Well, first of all, I think the U.S. market already had sufficient capacity last year, right? I think we're bouncing back from a pandemic. We saw a bunch of sort of revenge travel, earlier in this bounce back, and that was very leisure driven. I don't think we're going to see as much of the leisure driven travel this year, not the I got to pay whatever it's going to take to get down to Disney. So you'll see maybe a smaller growth amount in leisure, and business isn't fully back. We know that. So we've got more than 2019 levels of capacity in the marketplace, less business, and maybe a little more leisure. So when I add that all up, again, I kind of see a market that looks like it's got plenty of capacity. If you look at the guidance that Southwest gave on revenue per available seat mile, they lowered that at this discussion. So it tells me that the market is weaker at this guidance point. The market is weaker than they initially thought. And at the same time, fuel prices were a little bit higher. So what it looks like to me is Southwest numbers are going to come in lighter than we expected in 1Q. That's not a super healthy market. That's not a market that's got so much constraint that they can price whatever they want to for airline tickets and make lots of profits.
Okay, so it's like a trifecta. Like they do have a specific Boeing issue, and the fuel prices, and then the broader softer market. That's a general airline issue. United also told Boeing to stop building 737 MAX 10 jets for the carrier.
Yes.
Okay, that sounds dramatic and bad. What does that actually mean?
I think it sounds like Scott Kirby, the CEO of United, is just getting real about what he thinks Boeing can deliver in the near term. I guess, if you sit around and you kind of hope and hope and hope they're going to get the MAX 10 certified, and you wait on those deliveries based on that hope, and the certification keeps getting pushed out, and it's really hard to plan. So Scott Kirby said, hey, look, stop worrying about the Dash 10, just bring me Dash 9. He was saying, look, I just want airplanes. Bring me airplanes. I think the market's generally going to be strong for me. he's in the premium segment too, right? Which I think from the guidance we saw from airlines, premium is holding up better. So he wants airplanes. He wants to go out and find some of those 321 larger scale from Airbus. I think it's okay. I think Scott's being a realist. There's a lot of challenges right now at Boeing, and it feels to me like certification for the Dash 7 and the Dash 10, the Dash 10 being the biggest variant of the 737. There's just almost no way they're going to get pushed out longer than what we expect, given the problems in manufacturing at Boeing right now.
And what is that? So is there any read across that we should start thinking about for Airbus?
Here's the challenge of this industry, right? The read across is, look, Airbus ought to be able to go get a lot more orders for its Airbus A321. But the problem Scott has, and he's a really good customer and they're working hard to find him slots, is that they probably can't get him 321s for 4 or 5 years from now.
Wow.
So that doesn't fix his near-term problems. And customers that would be smaller than United have an even larger problem because Airbus isn't going to work as hard to try to get them into the delivery cadence. The industry is operating at sort of max capacity now. It's pushing its supply chains to do better, but we just don't see increases of build rates kind of more than 10-ish% per year at best. It's really hard to bring up that supply chain. So I think the duopoly means that Airbus can't really capitalize that well on this.
If you think about what the challenges are facing Boeing, is there much of a difference to the company if we get a soft economic landing, a hard economic landing, or no landing?
Honestly, I think for all the airframers, there isn't, right? So again, Airbus and Boeing building aircraft at rates much lower than their customers are demanding right now. Customers like Scott Kirby want to come in and buy A321s next 3 or 4 years, can't get them. So I think even in a hard landing, soft landing, no recession environment, these folks just keep working on making the supply chain better so the supply chain can put more of the components on the factory floor and build more aircraft. Although I would say maybe in a harder economic landing, it might free up some of the labor that they need and keep some of the labor more stable at their suppliers. And that's really the challenge right here is labor at the suppliers, stabilizing it. You need smart people there who've been doing the process for a long time so they do it right all the time, know the right processes and procedures.
All right, our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
Coming up, we'll break down why investors were excited this week about the computer tech company Oracle.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Jen Ryan. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Hey everyone, I'm Alix Steele.
And I'm Jen Ryan, filling in for Paul Sweeney.
We move next to ESG. That's environmental, social, and governance strategy. It's been one of the main themes over the past few years.
And you know, Alix, a net $13 billion was pulled last year from U.S.-based sustainable funds due to subpar investment performance and heightened political scrutiny. That's according to analysts at Morningstar.
So we were joined this week by Shaheen Contractor, Bloomberg Intelligence Senior ESG Strategist, and she took a look at ESG ETFs. And we first asked her to give her outlook for the ETFs in 2024.
In the US, we expect a continued pause. Now, I will say last year was the first time that flows turned negative. We saw about $4 billion in outflows from ESG ETFs. Though I will say that I don't think that represents some kind of like mass exodus from the strategy, and I'm happy to tell you why. I just see a pause, sort of less outflows but also less inflows. If you look at the outflows, most of it were from a handful of funds, right? So in a world where you have 500 plus funds, if one loses money, and it's really one that's all 50% of most outflows, it's a change in one investor sentiment. It's not like 100 funds picking up and selling off.
Do you think, though, money flows more into other areas of ESG ETFs, like in Europe, whose policy, and I guess commitment, I mean, I say commitment because we don't really know how all the energy transition stuff will shake out in terms of allocating capital, but where it seems like it's more consistent with messaging?
100%. So Europe is still 99% of the ESG ETF flows. It's about it's about north of 40 billion. And I mentioned US is a negative 4 billion, so a very big divide. That being said, in terms of strategy, we are seeing a bit of I want to call it an expansion, a move to climate, a move to more of the thematics, that kind of move, I guess.
Could you explain that a little bit more?
Sure. So when we think of ESG, I think of a broad sort of environmental, social, and governance strategy, all three. What I find people concentrating on more now is one of the E, the S, or the G, right? More of the themes. And I think a piece of that in the US is this push against the ESG label, sort of all three combined, which is why it's, focusing on something simpler like gender or climate, things like that.
Why do you think that in the US, ESG ETFs haven't been maybe as popular as over in Europe? Is it the quality of the ETFs, or is it the feelings behind ESG?
So I think it's two things. So first, they were very popular till about 2022, I want to say, almost as popular as Europe. It overtook Europe a little bit in terms of growth. That being said, I think the political backlash has had quite a bit of implication on its continued growth. Also, the one challenge in the US is that growth has been very concentrated to a few investors, which means that just a handful of investors put large chunks of money. So what we need today is we need a wider investor base, which I think is going to slow because of this backlash.
I wonder if you could talk a little bit about the sentiment there in the US, and can you, if possible, look ahead past the November election here? I mean, depending on who wins, who takes the Oval Office, what do you think that will do to sentiment?
I think it's definitely going to be driven by who comes into office, but at the same time also who controls some of the states, right? And that being said, the way I see it is if you have like the SEC regulation and you have a number of states suing the SEC because of that, that's going to continue to have a sort of a little bit of a negative backlash against it.
Also, you can make, the backlash started before we even were in the presidential cycle,
right. So I think the presidential cycle will have some impact, but I think the whole sort of backlash has to calm down a little bit or go in some direction for this to have, some impact.
What do you make of the idea that maybe ESG doesn't actually help companies' profits?
Yeah, I mean, I can't for certain say that ESG has proven to outperform. I don't think anybody can say that unless they've done some kind of fancy quant analysis. We're starting to do that. I think we still have too limited a time history of data to actually make any kind of implication yet.
It's interesting, though, because I always understood the support for DEI and the support for ESG came in part from the new generation of consumers, from millennials who want to vote with their pocketbook. And also the diversification that's coming in the United States workforce.
Right.
How does that play into your view that the ESG backlash might fade away a bit?
So I guess I have two opinions there. So my one opinion is we've been saying for years that this whole transfer of wealth is going to happen. We still see the ESG investor base as highly institutional. It's not very retail based. So in that sense, I haven't seen this transfer of money come into effect. Will that at least not in the ESG ETF world. Will that happen over generations and, over a time period? I do think so, but we haven't seen it yet, and we've been talking about it for a long time.
Our thanks to Shaheen Contractor, Bloomberg Intelligence Senior ESG Strategist.
All right, let's go to tech now. Look at the computer technology company Oracle. At the beginning of the week, Oracle reported total sales in the third quarter rose over 7% to $13.3 billion. That was roughly in line with analysts' expectations.
And Alix, Oracle also said that cloud revenue jumped 25%, and that excited investors. On Tuesday, Oracle shares posted their biggest gain in more than 2 years.
So we were joined by Brody Ford, Bloomberg Technology Reporter, and we asked him why the street was so excited about Oracle's results.
There's been a big debate over the last year. Can Oracle transform from this kind of old school on-premise, come to your office and install it on your servers kind of company to really offering cloud infrastructure the way we think about Amazon or Microsoft doing? The last couple quarters, they were disappointing, and people were starting to wonder, is this a flash in the pan? Is their growth sustained? They said, hey, no, we actually got billions more in orders than you expected. They had really strong bookings growth that's kind of reignited that enthusiasm that, hey, maybe Oracle really can be that, fourth hyperscaler after Google, Amazon, and Microsoft.
But I guess they've been having their ups and downs. Their shares got really badly hit, relatively speaking. And so do you feel like the recovery today is for real, or what's going to be the next way station that investors have to look for?
So what's convinced them is that when you're offering cloud services, people forget the cloud isn't in the sky, it's in data centers in Virginia. And they need to build them.
It's my quote of the day.
Yeah. And so Oracle said that they're going to spend $10 billion next year just building up these data centers. And keep in mind, a couple years back, they were spending $2 billion a year on CapEx. Now it's 10. That's a real difference. And that's convincing investors that, hey, they are actually building out their physical infrastructure. In the AI era, everyone needs more cloud. Everyone needs more of this computing power. And Oracle does seem primed to actually capture a lot of that demand. So people will be watching whether these data centers do go up in Virginia and other states.
I thought we didn't like it when companies spend a lot of money on stuff.
We like it if it's going to come back and give us something else, right?
Okay.
I mean...
But what's that time? So they're going to invest all this money. When do they make money off of the money they just spent?
Yeah, it seems like it'd be pretty quick because if you believe the executives on the call, executives grandstand sometimes, but they say that demand outpaces supply. They've been saying this for a while, that with the AI era, everyone's rushing to get more computing power. They can't provide it. So the second these data centers go live, in theory, they should be able to convert that into revenue very quickly.
Are they good at doing that quickly relative to other companies?
They are known for ruthless operational efficiency. There is. So they should be good at this, right? I mean, of course, the market could change, right? Everything looks rosy with AI right now. Everybody wants to train their own models. Could we see a sea change? Hard to say. But yesterday they got 80 billion in bookings. Once you book, you can't get out of it. So at least for a while.
So I also find this interesting if we're going to see cloud computing and AI be a cyclical industry or not. Like clearly it's a structural shift, but will we see a ton of data centers come on at the same time, like from different companies, and then therefore prices go down so the revenue isn't as hot? Like will it be cyclical like chips are, for example, or not?
It's a good question. There's one rule of software compared to hardware, that software is a lot stickier, right? I mean, you buy chips, you have them, you don't necessarily need to buy more. Once you start giving money to software providers, you plan on X amount of computational power, that usually doesn't go down. I mean, is there a point where the growth will level off? Probably. I struggle to see it being like hardware where, hey, everybody bought computers this year. Now the computer makers are SOL because nobody wants to buy anymore.
And then they've got you on the subscriptions, basically, like what we all have at home. But now, can you talk a little bit more about how Oracle is benefiting from AI?
Yeah. Well, and that's the big question for a lot of software makers. Every software maker, when they have positive results, they say in their commentary, this is due to AI.
That could be anything.
Right. They call their new cloud version the Gen 2 AI. Is everybody using it for AI? No. But what we know is that AI requires a ton of computing power, and Oracle has marketed theirs specifically for being good at training AI models. And so there's reason to believe that folks are upping their demand due to AI needs. But is this more than a couple of percentage point difference? Most analysts don't think so at this point.
So it's still the cloud. It's the cloud, the data centers, building all that out.
Yeah, think about any companies running all these records, the terminal, anything like that. Just it's more that kind of traditional stuff at this point than it is training models, though. That's probably part of it.
I did want to point out, too, that maybe you can comment on this one, that Bank of America, reason why they upgraded their earnings in part was because of an investment cycle from big tech. Microsoft, Amazon, Google, Meta, spending $180 billion in CapEx. They're in that reinvestment cycle. And I'm assuming guys like Oracle are going to be beneficiaries. Is that a link I can make?
I think it is probably more that they're all riding similar trends. Amazon, Microsoft, they've spoken also in recent quarters that their customers are really focused on cutting costs. That for the most part, everybody had transported a bunch of things to the cloud and then they wanted to cut costs. And that behavior was starting to change. The 2024 budgets got approved. They started feeling good again. And the investment was going up. And so I think it's more that they're all riding a similar wave.
I see.
Let me ask you something internally about Oracle. Who's running the company? Is it Larry Ellison?
It's crazy, right? Because you think about somebody like a Bill Gates, that's the same generation. He hasn't been there for a decade or more. But yeah, Larry's still running that. I mean, his title is not CEO, but he's chairman and he's CTO. He's, on the earnings call talking back and forth with analysts. for someone of his age and his generation, it's rare to see him still running the company, but he continues to, and there's no reason to believe that will change anytime soon. So it's interesting.
All right, thanks, Brody. Brody Ford, Bloomberg Technology Reporter.
Coming up on the program, a look at how predicting nature's catastrophes could become more profitable.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Jen Ryan. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hey everyone, I'm Alix Steele.
And I'm Jen Ryan, filling in for Paul Sweeney.
We move next to politics. Earlier this week, Donald Trump clinched the Republican presidential nomination, and this sets up an election rematch in November with current President Joe Biden, who secured the Democratic nomination.
For more, we were joined by Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. Nathan gave us his take on how investors should start to prepare for the election cycle and what sectors may have more at stake.
What this race is essentially coming down to three things. It's President Biden versus President Trump versus not voting. But from an investor standpoint, the way we're advising our clients right now is start with the geopolitical, the macro views, because that's where the power of the presidency is a little bit more powerful. And so you see statements like President Trump saying 50% tariffs on China. Well, we've been doing a lot of work with our FX strategists on what does that do for the euro dollar, what does that do for the dollar, and Bloomberg Economics has put out some great pieces as well on what that actually could be on the economy. And so the second thing to keep in mind is executive actions. What would a president do on day one? You know, for President Biden, I think it's just par for the course. Go back to his State of the Union, go back to the budget, and you'll get a little bit idea of his priorities there. But when it comes to President Trump on day one, you'll see a lot of executive actions which are directed agencies within the executive branch to go out and start regulatory changes. And that's the third aspect for it, is regulatory change. Now, regulatory change takes a lot of time. And so from an investor standpoint, it's something to keep in mind of, but those geopolitical factors of trade and tariffs and national security should be at the forefront of any investor trying to figure out how does the election apply to them and their portfolio.
So let's dig into this a little bit. Do you have any sectors in particular that could really have more at stake in the presidential election outcome?
Absolutely. It's energy, energy, and energy. And so the reason why I say that is there's this thing called the Inflation Reduction Act. President Biden signed this to law back in 2022. A lot of investors, especially non-U.S. investors, are taking the approach that because it's law, it's going to be law for the get-go. But in the IRA, there are a lot of tax carrots, if you will, incentives and grants and so forth to spur clean energy and clean energy initiatives. It's about 75% of the investment of the IRA is geared towards these tax incentives. Now, if President Trump wins on day one, he can put forth one of these executive orders directing the Department of Treasury or to the IRS to essentially just stop work, stop these incentives and so forth. There's some legalities that they have to work through here, but effectively they will be able to use a scalpel instead of a sledgehammer to start cutting away a lot of those clean energy initiatives.
Nathan, I mean, you're talking my language here. I mean, a lot of oil companies that I talk to like the IRA because they're getting subsidies, particularly if they're dealing in carbon capture. Some oil companies are also dabbling a little bit in hydrogen. I mean, this bill, they like it. It helps them.
Yeah, absolutely. But that's one of the disconnects you often hear about New York versus Washington. Because in the Washington sense, there was a bill earlier this year in which the Republicans put forward, essentially said, we'll gut the entire thing. And so the messaging is different. And, you know, the reason why we think, and our analysis is out on the terminal, we don't think that there's going to be that much change to the IRA other than specifically some of these EV-related tax credits is because a lot of the money and a lot of the infrastructure that's being built in the United States are going to red states. And so you often see statements from Republicans saying, I supported this initiative. And even President Biden in his State of the Union address last week said, look, if you don't want the money or you want to take credit for it, I'll certainly take the money and take credit for it. So I think there's this disconnect between what's happening in Washington and the markets. I expect that to coalesce if President Trump wins as the markets and especially Wall Street investors become to try and get into his inner ear and so forth, so to speak. But certainly headline risk, and you will see headlines associated with that going up into the election.
Our thanks to Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence.
On this program, we often look at our favorite Bloomberg Big Take stories of the week, and you can read them on the Bloomberg at bloomberg.com/Big Take. And this week, we looked at the story of how a physics whiz made a fortune betting on nature's catastrophes.
It delved into why predicting nature's catastrophes is in fact a big business. We were joined by the story's author, Gautam Naik. He's a Bloomberg Senior Editor covering ESG investing. We first asked Gautam for more background on what this story means.
It has to do with insurance. So traditional insurance and reinsurance, do a fairly good job of covering modest and medium-sized catastrophes, storms and hurricanes and earthquakes. But every 30, 50, 100 years, you get a Hurricane Katrina-like event, which is completely devastating in its scope. And that's the kind of event that traditional insurance company can't really handle. So they've turned to a new type of asset class. Well, it's not new, it's been around for 25 years, but it's really coming into its own more and more now. And it's called catastrophe bonds. And the way it works is that instead of the insurance company taking the risk, should a disaster happen, that risk is passed on to Wall Street investors. So if the disaster does happen, the Wall Street investors can lose some or all of their money. So it's a pretty risky move. But if it doesn't happen, and these bonds they run for only 3 to 5 years, not for much longer. If the disaster doesn't occur, then the investor gets to keep its original capital plus gets a hefty return on top of that for taking that risk.
So your story, it's fascinating, and there's something to dig into there, but you start off taking a look at Fermat Capital Management, and this is the owner of the world's biggest collection of catastrophe bonds. Can you talk a little bit about their strategy? And in particular, I just want to circle back to a comment that you made just now that in this current environment, this market is very, very interesting. And I wonder if you could talk about how a warming planet is figuring into Fermat's strategy.
Sure. So, there are always hurricanes and earthquakes, but the problem is that more and more people are moving to Florida and California and other parts of coastal regions in the world where, they want to have a nice view and a nice seaside experience. But those expensive homes they're building, when they get hit by a storm, they, tend to lose a lot of money. So that is the real problem, is that human beings are moving to these risky areas. And the insurance industries, either in some places like California and Florida, walking away from it. They're not going to insure people. The risks are too high. Or they're turning to this kind of instruments like a catastrophe bond to do so. So Fermat Capital is the world's biggest cat bond investor. Their assets are about $10 billion. And they have a very interesting strategy. So like other cat bond investors, they do buy these risk models which help you to predict the likelihood of a hurricane occurring in a particular year or over 2-3 years. But what they do is they add a magic sauce, that because the co-founder of this firm, John So, has a physics background, has a biophysics degree from Harvard, he's been able to layer an extra sophistication in trying to predict the likelihood of risk and return for each of these potential catastrophes. So his buying approach is quite clever and sophisticated, and he hopes to get an edge from that. So that's where Fermat has really, they've been involved in this market almost since its inception, and they use this extra edge to try and beat the market and other cat bond investors.
And has it worked? What are the returns like?
Yeah, so the returns last year, which was a very good year for all investors, about 20%. And I think a lot of other investors also came in at that level. I should say that the interesting thing about cat bonds, it's a really good diversifier. So, unlike your regular, stocks or bonds that fluctuate with market movements or the Federal Reserve's decisions, a catastrophe bond's outcome is down to Mother Nature. Either she's kind or she's unkind. And if you diversify a portfolio with cat bonds and you get the benefits of that, it's a really good diversifier that has no correlation with the rest of the financial markets.
Can you talk a little bit about how the current environment in the insurance market is affecting Fermat's returns? Because, you make the point in the story that a lot of insurers are charging more to protect customers from devastating weather.
Well, last year was a record year for the issuance of catastrophe bonds. And this year is looking likely it's going to be, again, a pretty solid year. And that reflects the insurance industry's desperate need to pass on some of this risk beyond the traditional reinsurance industry to Wall Street. Wall Street is a huge, deep pocket with trillions of dollars at its disposal. A lot of, risk-taking investors, unlike traditional insurance, which is a lot more conservative. So as you can see from just the number of new issuances that are lined up for 2024, that insurers are increasingly turning to this market. So one of the issues, a problem, is that secondary perils, as the industry likes to call it, so floods, wildfires, and thunderstorms are causing more and more insurance damage as opposed to, a Hurricane Ian or Hurricane Katrina-like event. And insurers are trying to figure out how can they protect their own portfolios, their own balance sheets, but also provide insurance to people. When you have more of these type of events occurring, this sort of medium-sized $5-10 billion disasters versus, the once in a 30-year event, and at the same time try to make sure that, their balance sheet is protected. Mm-hmm. That's not so easy to do because we don't have much data on these kind of secondary perils. And also the models that are used that give an investor some certainty that, okay, they don't stand to lose. Typically a rare hurricane, the loss estimate is somewhere in the region of 2%. It's fairly low. The return you can get is something like 8-9%. Mm-hmm. So as long as that clarity isn't there for these tornadoes, thunderstorms, ice storms that you see in Texas, as long as that's happening, the insurance industry is going to find it difficult to access the cat bond market to cover those kind of perils, which are becoming more common.
Gautam, what are the main risk events that now a CEO is modeling that may or may not happen? Because he basically has to model what he thinks will happen and then either take a little bit more risk but for more reward or avoid that altogether. Well, what are the things he's seeing right now?
Well, they own something like 250 or 280 individual catastrophe bonds, and the whole market maybe has 320 or so. These are rough figures. So they are very dominant. They own a vast swath of this whole market. That could include a tsunami cat bond for Japan, a typhoon cat bond for the Philippines, a hurricane cat bond for Mexico, all kinds of different events. So I think their modeling is primarily focused still on the big potential disasters, such as hurricanes or an earthquake in California or wildfires in California, and less so on things like thunderstorms, because again, they don't really have the data or the sophisticated models yet. But they're building up that because that's where the catastrophe bond market is going to grow. It's going to move away from the kind of Hurricane Katrina-like events, the rarer big disaster events, and more to, Hurricane Sandy-like event, which, there is a cat bond for. The New York subway system has acquired a 100 million cat bond. I think they've renewed it perhaps for the third time now to protect the subways from going underwater should a Hurricane Sandy-like event hit the city head on.
Our thanks to Gautam Naik. He's a Bloomberg Senior Editor covering ESG investing.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.